Welcome to Investors Hangout. This fortnightly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, starting 1st of January, SEBI has mandated fund houses to disclose how risky a particular mutual fund scheme is, from low to very high risk. And to discuss how will this risk be calculated and how will it help investors make more informed decisions, with me today is Dhirendra Kumar, CEO Value Research. Welcome, Dhirendra.
Thank you, Ruchira.
So first things first, Dhirendra, I believe the riskometer has already been there for some years. So firstly, I'd like to know what was the need for these new provisions?
There was a need. The riskometer came into being in 2015, and now there was a realization that they were static. They were not reflective of the real risk. Risk is not very precisely measured. It has to be broadly measured, and it should not be very off the mark. And the recent crisis that we have seen in the fixed income universe or the equity universe, where the understanding of risk, because you can measure return very precisely. This fund gave you 15% return, this fund gave you 18% return. You can't measure risk, and risk will visit you once in a while. So you have to really be, the gradation of risk based on general principle that we have for equity fund and debt fund. It was needed that it cannot be, because so far the riskometer was reflective of the general, SEBI has classified every fund into a defined category, and there was a riskometer specified for each category. So that was it. Every fund in a certain category were assigned a similar riskometer, were on the same scale of the riskometer. But within a category, a fund can be more risky or less risky depending on the underlying characters. Also, once you have assigned once you have a definition of a risk based on a certain underlying portfolio, the portfolio can change. The fund manager can buy and sell something in a manner that it can become less risky or more risky. So making it dynamic and making it better reflective of, it should not get slotted. So it just became somewhat of a more static, less dynamic thing, and that was a good starting point. I think what we are witnessing right now is a refinement of the riskometer, becoming better reflective of the underlying risk of the funds, and it's a step forward.
But what exactly has changed? Tell us, how are the new provisions different from what already existed?
Two things. One is the scale itself has changed. Earlier there were, it was on a 5 scale, so that is not very significant. The real significant thing is that now riskometer will be changing every month depending on the underlying portfolio. You can have two funds in the ultra short term bond category, and they can have different risk scale depending on the underlying, and the methodology has been specified by SEBI. Depending on the underlying characters, there could be two portfolio in the same category of an equity fund or a debt fund, which can have varying level of risk, and that will be reflected here. So investors can choose based on different risk parameter, different risk scale, or riskiness of an individual fund in a certain category, and it will be possible, and hopefully it will be a better reflection of that.
All right, well, that makes sense, but how effective or useful do you think this new riskometer for the investors will be?
It is going to be very effective for the fixed income fund, but like any methodology which is specified, there will be some corner issues. There will be issues which has to be resolved. I find that we have just looked at the preliminary slotted every equity fund in the same category with the new riskometer, and there we find that the differentiation is not much. The very risky sectoral fund, or even the riskier sectoral fund, based on its concentration, are becoming very high, and even an index fund or a large cap fund is also becoming high. My understanding is that the methodology should actually differentiate between them, because one is definitely more diverse and less risky as compared to a concentrated portfolio. But I would say that it's still a step forward, because we have better thing than we had, and I think it is up for review, or once we have this framework, it will be up for review and refinement and other things. So matter of time that it will improve further.
All right, time now to move on to the viewers' questions, and the first one comes in from Rajesh. Rajesh asks, can fixed income investors rely on the riskometer while deciding to invest? How should they use the new riskometer?
Yes, I think in case of fixed income fund, the riskometer will become more useful, because everybody looks at fixed income fund primarily with one eye, with one yardstick, which is return. But return hides a lot of risk, and just if you are just guided by the risk by the return, then you just might be buying into a risky fund and you may not be aware of it. You will I hope that this riskometer will clearly differentiate the fixed income fund based on the riskiness, because this riskometer of fixed income fund will be dependent on the interest rate risk and credit risk, and these are the two, and the liquidity risk. So these three factors will determine that. So, and these are real risk. We have seen that 6 Franklin funds got stuck because of liquidity risk. The perception of credit can actually change, and that could be a credit risk. Or we have seen funds in recent past, nearly 1.5 year, where a lot of funds have been hit by the credit risk. Likewise, interest rate risk, and this is something which is coming on our way. Interest rates are so low that coming 6 months to 1 year, we will see interest rates going up. Which fund is able to navigate the rising interest rate, because that is a time when many funds will actually take a hit, will decline in value because interest rates go up, because debt funds have this inverse relationship with the interest rates. And which fund is able to manage it better with the maturity profile, with the liquidity of the underlying investments or the security that they have. So I would say that yes, in fixed income fund it is going to become very meaningful, and investors will start looking at it, and more importantly, it will change, because so far we were stating that these kind of fund are this much risky, but the funds could be much more riskier. So you can actually monitor the return. Now you can monitor the risk.
And how should they really use the new riskometer? How should they be using it?
If you find that a fixed income fund has moved to moderately high, or a moderate from moderately low, then it is time for you to worry. And this is something for which you will have to come to Value Research Online, set up your portfolio, and all such changes we will be keeping track of, and we will be posting it alongside your portfolio or in the listing pages of all the fixed income fund as well as equity fund. The risk will be made available upfront.
Okay, now the next question has been sent in by Vibhor, and it's somewhat related to what you just said. He says the risk rate of the equity fund he has invested in has moved from high to very high after the new provisions came into effect. So should he be concerned?
No, not really, because most equity funds are going to witness this kind of change in their risk gradation, so to say. So not much, because I would say that it has been the equity risk gradation, the riskometer has to be refined further. It is far from being perfect, or it is far from being realistically okay. So I would say that most equity funds are going to get slotted into high and very high, and many of them will be very high. So if you are looking for relatively lower risk in a equity fund, you are unlikely to find one.
Yugender Janjarala asks, what factors are responsible for fluctuations in case of debt funds?
The primary factor is change in the portfolio. If a fund is facing a liquidity issue, if a fund is facing some massive withdrawal, as we witnessed, then it will be facing some liquidity crisis, it will be reflected. If a fund has changed its portfolio and it is getting into relatively more safer fixed income instrument, that will also get reflected. It will actually improve on the risk in terms of becoming less risky. So because portfolios change, because the fund managers go about making change in their portfolio, the risk changes, and this riskometer will reasonably reflect that.
Now, Rajat says, given that the current markets are driven so much due to liquidity and they're in a euphoric phase, what should be the strategy for someone who is only 3 to 5 years away from his retirement?
Err on the side of caution. If you are going to retire in 3 to 5 years, just understand what is your income requirement, and then look at what is your retirement accumulation. If you have substantially higher, if you are way above, way more than 4% annual, measure it by this formula, that if your income requirement on a monthly basis multiplied by 12, that is equal to 4% of the accumulation that you have already done, which means you have reasonable accumulation. If you have a crore of rupees, and if just to put it in perspective, if you have a crore of rupees of accumulation in your retirement, and 4% means 4 lakh rupees, and that will be enough for your income requirement through the year, then you are okay. Which means, but err on the side of caution, which means take up to 3 years income requirement in a fixed income fund. That is the minimum that you should be doing, and then change your asset allocation. Have about 60% into equity, 40% into debt, so that even if the market goes down, you have actually built-in shock absorber from the decline in the market, and 5-7 years is good enough period where you will have a next cycle.
Barjeet Singh has a horizon of over 5 years and an amount of 12 lakh rupees to invest. He wants to know how and where should he invest it. He cannot invest in direct equity shares due to some office restrictions, he says.
Every investor should be guided by two things. One is the time frame, which he has clearly stated, over 5 years, and then his experience. If he has never invested in market before, he has never invested in even the tax saving fund, then he should consider a hybrid, aggressive hybrid fund. That's a balance. That is the erstwhile balanced fund. They are typically 65% into equity, 35% into fixed income, so 1/3 into fixed income. They are a steadier take on growth, and they don't crumble, they don't fall freely when the markets crumble. So that's a nice way to start. But another rule which one should apply, which is, even if you have these 12 lakh rupees, don't invest at one go. Spread this investment over the 12 months. Over the next 12 months, you will be able to average your investments, and it will also be a great shock absorber against your own behavior, because when you invest 12 lakh rupees at one go, you see a 20% decline, and then you lose your cool, and then you are in a hurry to get out of it at the earliest occasion when you will break even. So that will also help you navigate the market and get a nice footing with confidence.
All right, now Uma Shankar asks, is it advisable to invest 50,000 rupees in one go for his kid's future? It'll be for long term, and he plans to opt for a direct plan.
Yeah, if one is investing for 10-15 years, and if the 50,000 rupee is going to be one time, but you will be investing subsequently, then by all means do it. If you are going to invest something like that, or 25,000-30,000 rupees on all his birthday over the next 15 years, then this is also your annual SIP, so to say. So you can do it.
Okay. D. Santosh Kumar wants to know if it's advisable to invest in land or a house.
I would say that one should be aware of all the returns of all the complications or all the pitfalls of investing in a land or a house. One is that one should definitely buy a house, and one should follow the guidelines in terms of you are not stretching with the extended borrowing, or you are buying a house which will fulfill your requirement, and it turns out to be buying a house could be very meaningful for somebody if you are going to live in that house, save on the rent. And because for most people, if you have no other saving, no other way of accumulating, it turns out to be a very meaningful way to accumulate the only wealth which you have. But otherwise, if you are looking at it from an investment point of view, I would say that real estate comes with its own set of problems. One, the ticket size is very big. The other is that to be able, there is a cost of maintenance. You have to keep an eye on that. It requires, it's not as simple as buying a mutual fund with ease and selling it at one go anytime you want to. But if at all, if for any reason you have committed to investing in real estate, for some reason you think it is you have to, then I think follow the simple principle. Houses, homes depreciate, lands appreciate if for some reason. So if you have to make an investment and land, you can take care of the land, then go for the land.
Today's last question has been sent in by Janvi Parbat, and she asks how to search for the right mutual fund scheme for investing.
I think I've answered this question in some other context, but I'll explain it again. 2-3 things which actually should guide your fund selection, which is which kind of fund to invest to begin with. So that entirely depends on the investment time frame, your experience, and if these 2 things are, if you have done it well, then you will not be disappointed, because if you are a first time investor and if you are going to invest for very long period, still get started with an aggressive hybrid fund. If you have some experience, then maybe invest in a multi-cap fund. If you are going to save for taxes, and that will get you a tax break at the same time, this is going to be a long-term fund, long-term investment, then invest in a tax saving fund. So these are way to start. Then comes choosing a good fund. Come to Value Research Online, look at the listing of the right category based on the things that you have, which I have listed, and choose the best fund from the category.
That's it for now. Thank you, Dhirendra.
Thank you.
Thank you to all our viewers. Do keep sending us your questions and keep watching this space for more information. Bye for now.